Welcome to join me with this new series called In the Moment. This series will have 6 topics, and I have created the series to really keep you in touch with what's happening, for you to understand what's going on, and guide you through all of this changes that is happening just about on a daily basis. So, the topics that I will be sharing with you in the coming weeks will be of different topics. The first one will be about the Bank of Canada interest rate versus the mortgage rate that we're seeing today. Why is there a difference? And I will provide you with more details on that subject today. The next topic, we will talk about the mortgage payment deferral. What does it mean? And you'll see that different lenders will offer different things. So I'll provide you with some samples and some examples of that. The third topic I want to bring to you is about Equifax. I had a webinar today with Equifax, and there are some new things coming down the pipe, and I wanted to share that with you. The next topic will be about what are your options. By that point, hopefully, we'll have a clearer understanding what's going on with COVID and whether or not we're ready to turn the page, maybe, and start looking at how we can recover for this. And then the next topic will be about economical recovery. I attended a webinar from Deloitte, who really keeps an eye on international countries' financial and how the market are reacting. So it was a really interesting webinar to be part of. Because they shared a little bit about surveys they've done in September and early this year and what they expect to see in the coming months. So hopefully you'll join me with each and every one of these webinars. So let's start with today's topic, which is the Bank of Canada interest rate versus the current mortgage interest rate that we see in the marketplace. So why is there a difference? Well, first, I want to take a step back and just start with the basics so that we can be all under the same understanding. So the Bank of Canada, what is its purpose and its existence, what is it for? And the definition that I was able to draw was the Bank of Canada's existence is to regulate credit and currency in the best interest of the economic life of the nation. And the core function is applied towards 4 main areas of responsibility. The first one is about monetary policy. The second one is about the financial system. The third one is the currency. And the fourth one is about fund management. So today we're going to focus on the monetary policy. The Bank of Canada carries out monetary policies by influencing the short-term interest rate in the market. It does this by lowering or raising the target of the overnight rate. What is the overnight rate? It's important to understand what it is. It is the interest rate at which major financial institutions can borrow or lend money overnight, funds to other institutions and lenders alike. The Bank of Canada sets a target level for that rate. So if you go back to March, the Bank of Canada changed its overnight rate 3 times. It went from 1.75 all the way down to 0.25. Let's understand that the overnight rate is a cost of borrowing to your bank. If they lend the money, they get that 0.25 in profit to have borrowed the money to another bank. If they borrow the money, they have to pay that 0.25 to be able to get access to that extra funds. So now let's take a look at the big banks. What does it mean to have, when we talk about the prime rate of a big bank, and how do they set mortgage interest rate? So let's start with describing what the prime rate means. It is the annual interest rate that the Canadian major bank and institutions uses to set the interest rate for variable loans, line of credit, including variable rate mortgages. So the prime rate is influenced by the overnight rate, which is a cost of borrowing. If we look at the overnight rate at 0.25, and I look at the current prime rate that the bank uses to set their own interest rate of their own product, the prime rate they're using today is 2.45. So there's quite a bit of a gap in between the 0.25 and the 2.45, and that is the profit that the banks are using to be able to continue their operations. So now that I have established what is the overnight rate from the Bank of Canada and what is the prime rate from your regular bank, and the differences in between the two of them and how they influence one to the other, and the fact that the prime rate will influence the variable rate on your loans, on your credit cards, on a mortgage that is based on a variable term and interest rate. So as you can see, these kind of intertwine one to the other. However, the question remains, how does a fixed interest loan, like a mortgage, is set? What do they use? So again, I'm going back to the cost of borrowing, because the bank do have a lot of money, but they certainly don't have all of the money in the world to be able to lend everyone a mortgage, right? So they have to borrow some of that money from somewhere. So there's a cost of borrowing there. Where do they get their money? Who are they borrowing the money from? The money is borrowed by the bond market. Looking at the bond market since last May, it peaked at some point at 1.65, and that rate kind of stayed steady fairly along the way up to December 31st, 2019. There was a little bit of a dip in September just before the election, but it got back at and ended up at 1.68 on December the 31st. So starting the New Year's, we used that rate. And it's only on September the 19th that we saw a drop in the bond market. And the bond market went down to 1.36 on February the 19th. But from that day on, the bond market continued to decrease and going down and lower with some inflection here and there. But realistically, it went as low as 0.55 on March the 11th. Ever since then, the bond market has been going up and down like a yo-yo. So, knowing that the bond market is a cost of borrowing to the banks, and currently the banks are using the bond market rate today is 0.67. So the cost of borrowing is 0.67 for your bank. So now the interest rate on your fixed mortgage will be based on that. And there has to be some kind of a cushion, because the banks and the financial institution over many years have made their business to make sure that they minimize the risks, as well as bring some pretty good and cushiony profit to their investors. And right now with COVID-19, the investors are still demanding more return on the mortgage bonds to offset the increased risk in the mortgage industry. They are also concerned about more borrowers being laid off, which means that lenders will be facing higher level of default payment in the coming months. Lastly, the volatility of the bond market. The lenders have to adjust their interest rates just about every few days. Currently, a 5-year fixed interest rate could be as low as 2.79. If I look at the bond market, as I mentioned earlier, currently today, the bond market is set as 1.67. So if we take the two of them, we can see that the bank will have a profit margin of 2.12 minimum. And that will help the bank ride out or absorb the upcoming potential loss in the coming months. Because the 6 months deferral, they still have to carry their operation, although it might be less than in the past, but there's still some operation to be paid. And they still have to pay some profit to their investors. So they're trying to minimize their risk. So we have to take that in consideration, that the 2.12 profit margin, with the fact that realistically there's not that many mortgage requests right now, so they're just trying their best, like everybody else, to be able to minimize the risk and still bring some profit to their investors. Before I finish up, I'd like to talk to you about the qualifying rate. We all know that there was an announcement earlier in February, March, where the Bank of Canada mentioned that the qualifying rate for a purchase or refinancing of a mortgage will change as of April the 6th. Well, we have seen that change occur, and I can tell you now that it is set at 5.04. It is an improvement from the qualifying rate that we had to use prior to April the 6th, which was 5.19. This will assist you having a little bit more borrowing capacity. It's not a ton, but for some people, it might just be enough to be able to qualify for a mortgage compared to in March, they may not have been able to. So just to summarize what we talked about today, the Bank of Canada overnight rate is the interest rate that the banks are charging or getting when they lend or borrow money with other institutions, financial institution, obviously. The prime rate is set by your bank and it's the interest rate used to be able to set the variable interest rate on the product they will offer to you in the future. And the fixed interest rate mortgages and loans are really based on the bond market, not on the overnight rate or the prime rate. So hopefully in this short video, my goal was really to explain to you in the simplest way possible the difference in between the interest rate and how they are relating to one another or influencing one another, so that you can understand a little bit what's happening. I would love to hear from you. You can email me, you can send a comment on this page or like me on this page, and to let me know whether or not I have reached my goal. So thank you very much, truly appreciate it. Have a great day and we'll see you soon. Bye-bye.